Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're going to look at three key aspects of new news that's come out. One is the EIA. Another is going to be storage and crude that's been moving around the world in terms of exports. And then the third, we're really going to dig into some refining and what that means for crude demand on a go-forward basis. So let's turn to the EIA and look at the numbers that came out. So on a top line level, the crude draw was pretty good. You had some draws specifically in Cushing that was key. And even though the production numbers look like at 11.5 million barrels a day, it's actually closer to about 10.5 to 10.6, depending on the adjustments. So we're seeing those shut-ins start to come through. We're starting to see that slowdown in completions, as we talked about in the Primary Vision Frac Spread Count. Those new completions are slowing. We only have 47 that are active, and these are the shut-ins. Now, the problem is with the crude pricing, specifically WTI responding, now you're starting to see some of these shut-ins get reversed. So we're not seeing any real new activity, but we are seeing some shut-ins start to come back on, and some of those chokebacks, which is just when you limit flow, start to turn on, and you'll start to see that appear as the pace of some of these draws, specifically in Cushing, starts to slow. But remember, we have to include the SPR. So the draw, was 3.1 million barrels. But let's pull out and look at, okay, well, what's the most important? So the first one that we're going to look at is Oklahoma. So obviously we, in WTI Cushing, we see that we've had a big draw where this was, I think it's the largest that we've had ever, which is good because we were getting close to that top that we had earlier in 2014, 2015, and we're starting to come further down and closer to normal. And that's just because crude is moving away from Cushing and trying to find other homes, which is why the next chart really looks at oil inventory in Pad 3. Pad 3 being the Gulf of Mexico, you can see that it's essentially attracting a huge amount of oil down into the Gulf of Mexico, and you can see that it's at all-time highs going back to 1991. This is going to be a problem because we have floating storage, which we'll talk about in the next segment, and that's increasing, as well as the oil storage within the whole area. So this is something that's going to have to be worked through in order to really see any kind of pickup. But in order to see pickup, you need to see refinery utilizations pick up. And in order to see that, you need to see more drawdowns in the product. So when we look at the product and the imports and the runs, you can see that like last week, we said that we were going to see 70% or so utilization rates. We came in at 69.4. This is something where we'll see a little bit of a tick up. We think we'll be closer to about 71, 72% next week. But now, mind you, we should be at 91%. And this is going into a holiday weekend, which is typically the kickoff for summer driving season. So this is where Memorial Day is when you start to see that those vacations start to pick up, people start driving, that will be impacted. So when we look at implied demand, we saw that demand actually declined. And the problem is the comps are only going to get harder as we go into May, into June. So the demand picture, like we said, we were going to have a strong bounce off the bottom, but then things were going to start to normalize, and we're starting to see that right here. Distillate was another where we saw another slowdown, but the big key is the refinery runs. They did tick up. We think that's going to be relatively stable, but they still need to work through all of this product in order to work through the crude. And that's why we saw imports, really kind of slow down and utilize that floating storage, because they really need to marry runs with the crude on the water. So let's just take a step back and look at where normal DOE utilization rates typically are. You can see how far we are off of our normal going back to 1991. Typically, we should be on our way to about 95 as we go through June. And you can see that this is just not something that's going to be a possibility, just given the overhang on the product side. Now, when we go to the next level and say, okay, well, what are the products that matter? We've talked about distillate and gasoline. Distillate is still one that we're watching. It's gotten a little bit better in terms of demand, which is good because it means that you have more trucking, you have more things turning back on, but it's still at lows. And this low is also going to attract more jet fuel as the kerosene gets blended into distillate, because jet fuel still remains a problem. So the big issue as we go forward and we continue, we can look at gasoline. Now, gasoline was the one that had the big bounce off the bottom, but we've really kind of normalized and we've actually slowed down a bit. This is a calculated number. Now, when you talk to people or just yourself in thinking about, well, when was the last time I filled up my tank? You're not filling up as much, but you are filling up. And people were preparing for Memorial Day. The system was being backfilled. So this is a good component in terms of where we kind of think we level off. We do think we'll get to about that 8 million barrels a day of demand. And that's just because we're going into Memorial Day. We should see a tick up. People are tired of being at home, so you'll get that normalization. But it's still going to be well off of norms. And we think that we're going to kind of hold in that level over the next few weeks. Now, when we look at exports, it's a key component to how are refiners going to continue to increase runs. And if you can't get it, the domestic demand, well, what about the export markets? You can see the export markets really slow down and remain an overhang, specifically in gasoline and distillate. You had a small bounce, but that's something that's going to pare back because the arbitrage, which we'll talk about a little later, between Europe and the US remains at all-time lows, or at least in multi-year lows. And Latin America continues to struggle under the weight of COVID-19. Oil exports is another one where the crack spread. So if I'm a refiner, the crack spread is what do I make money with? Do I make money running Iraqi crude, Saudi crude, US crude? The crack spread as a refiner is actually going down for the US. So that means that there's going to be less demand for US crude going forward because prices have really outstripped where they're selling that product. And we can really pull that out and focus on where are those exports. So you can kind of see that bounce off the bottom with the first one looking at gasoline. We had that bounce off the bottom going back to 2011. But we think we're going to kind of bump along that line and print new lows over the next 2 to 3 weeks, just based on the shipping the ship trackers that we're following. The next is really distillate. Distillate had a little bit of a bounce. We had some additional shipments go to Europe, and the problem is a lot of this distillate also goes to Latin America. And as we said before, Latin America continues to struggle. So we think that we're actually going to print the lows on distillate exports as we go over the next few weeks. So when we look at the overall gasoline distillate component, you can see the surprise that we had with the gasoline build and the distillate build. The gasoline build was one where people were expecting another drawdown, but you're getting this weird mix now as demand starts to slow or starts to normalize. You'll get a little bit of a move higher, but also refiners were preparing for the driving season starting to come up. So this is something where we're going to see this really start to have a little bit of a problem. And the builds they won't be exponential like they were, but they will kind of normalize. Distillate is one where we're going to see additional builds just because it's a place to put both diesel, but also kerosene or jet fuel. And you're going to continue to see that kind of marry. Now, in the next segment, we're really going to focus in a bit more on spot pricing and the global outlook. But because we really want to tie in what's happening in the world when we look at exports and floating storage. We'd like to start doing a little fun exercise of a question of the day. Today's question is going to focus on Memorial Day. What did you do last year? What are you doing this year? And will you be traveling? I know for myself, last year I went to Rhode Island to see my in-laws, and this year we will be hanging around the house, consuming zero gasoline and not driving anywhere, trying to enjoy the warm weather. So leave a comment, let us know what you're doing, and we'll talk to you next time. When we talk about production and things turning back on, we have to consider the spot pricing. Now, spot pricing is really where the physical market is entering and what the companies are actually receiving. So when we look at North America crude spot pricing, you have to consider where we are in comparison to other grades in the world. And when I say that the US is going to have difficulty in the export market because of the pricing, that's where you have to look at Louisiana Light Sweet or LLS and Magellan. Those are two areas where when you look at them, you have to consider it costs money to ship, for the insurance, to get from point A to point B. So these are issues that are going to be a hindrance to seeing a bigger export market. So we actually think that US exports decline by about another 700,000 barrels a day, which is going to trap more crude within pad 3. Now, when you think about, well, what does that mean? Now let's look at the overall picture of the US and look at total inventories across the board. We like to look at it from the perspective of total products as well as total inventory, and you can see they continue to rise. Now, they're still off of some previous highs, but it's still something that's going to continue to climb higher with gasoline kind of normalizing here, but distillate and crude continuing to start to offset and continue to kind of push that up. But we have to consider what the global landscape looks like, because we have South Korea, which is near all-time highs and is starting to cap out the amount that they can store. But that's also slightly offset by India starting to reactivate, a little bit of refiners going from 0 to 20, 40% utilization, and China continuing to be relatively stable at their about 70% utilization rate, mixed between the teapot refiners or the independents and the state-owned facilities. Now, those are things where even though they're increasing operation, we're seeing more product or more refined product hitting the market. And something to watch is specifically China, where you have new rolling lockdowns on about 100 million people. So when we think about those rolling lockdowns, you have to consider the US, Japan, and Fujairah. And these are three areas where you continue to see crude and distillate build. Now, those two components, crude, obviously, it's oil, what is it being moved into? And distillates continue to build as well, which is a problem for the overall shipping market and the global shipping market. We've seen some recovery in the US, but on a global level, it's still very sluggish. And when we look at the overall crude oil floating storage, you can see that it's starting to pare back a little bit. We've hit a peak. You've had Russia, Saudi Arabia, other OPEC nations start to normalize. This was really kind of driven by West Africa and OPEC that have started to push some of this crude into the market. But when we look at floating storage broken out, you can see that Asian crude floating oil storage is continuing to move to all-time highs. And this is really driven by India still having a lot of cargoes. They're maxed out. South Korea is maxed out. And Singapore still remains at all-time highs. China has seen a little bit of a pullback in terms of what's floating, but they've been out there aggressively buying. Now, why are they buying? In March, they canceled a slug of April shipments, and they delayed purchases in May. So it makes sense for them to now kind of rush back in and say, let's buy what we can, let's get the best price what we can. And we've seen some tightness in the official selling price, which we'll talk about in the last segment. Europe is another one where we saw a quick pullback, and this was as things were normalizing. We had barges moving through Rotterdam. We have Italy starting to restart some refiners. We have other guys starting to ramp back up, and this pulled more crude into the market. But that is also starting to slow down, and we're seeing builds ramp back up as things are moving from Nigeria into Europe. And to round out, it's good to look at what is 2019 over 2020 when we look at OPEC plus seaborne oil exports. Thanks to Kepler, they've shown how there has been a huge step back in terms of new exports. But when you think of the amount of oil sitting in the water, you have to have that drop because you already have things on a boat that have to be pushed into the market to clear that glut. So this is something that has to continue over the next, let's call it 6 weeks to really start to see some of this pricing in the market remain sticky. The next segment, we're going to say, okay, well, now that we've looked at oil, how oil is moving, let's figure out, well, what is the refiner doing? Because even though oil prices have increased, it doesn't mean that refineries are making money because it's actually outpacing the total product price, which is going to impact how fast these refiners increase runs and the demand for oil, which we think is going to have a big headwind as we go through the next 6 weeks. Now that we've talked about the EIA, where we think things are going forward and what storage looks like, we really have to look at where the rubber meets the road, and that's refining. Refiners are the largest buyers of oil, and we have to consider what are the margins they're getting, and are they really going to increase their demand for crude given the product supply glut and what the pricing looks like. The first chart here looks at Northwest Europe, jet fuel versus gas oil. So you can see the jet fuel demand has started to pick up. Pricing has gotten a little bit better. We're still at all-time lows, but it means that there is a little bit of a softening. There is some jet fuel demand starting to emerge, which means that you'll be a little bit less likely to blend jet fuel into gas oil, which is why we're looking at the two of them. It's still a ways to go, but it is a little bit of a softening in terms of where the demand is and some recovery. The next one is looking at the U.S. Gulf Coast. So this is just a good one. Again, this is more of a financial instrument, the 3-2-1 that we've spoken about. It's still bumping along the bottoms. It's really at a pricing level that we haven't seen since the 90s. And the issue here is there's not a lot of money to be made in the gasoline market. It's starting to get a little bit better. But even as some of the gasoline numbers, which we'll talk about in a minute, have flipped positive in different locations, it still remains, the distillate and diesel still remains an overhang for some of these margins and demand numbers. And that leads us right into this gas oil futures. And when you look at gas oil futures, you can get an idea of just how weak some of this demand is and how the margins continue to kind of be missing when we think about what is diesel, when is diesel production going to go up, when is demand going to be there. And you can kind of see even at these prices, diesel, gas oil, that disty cut isn't really seeing that kind of demand. So when we think about, gasoline and we consider where things sit, you can see that now this is just looking at gasoline RON, not to get complicated, but RON is just a measure of octane. So when you look at the tank, and it says 87, 89, 91, 93, that's RON plus MON divided by 2. So this just gives you an idea that it's more of an enriched gasoline cut. It's flipped positive, which just means that you're not losing money making gasoline, but it's still well below where it should be. This is an indication, though, that gasoline demand has picked up. You're starting to see, you're actually not losing money anymore, but as gasoline moves up, we've seen that gas oil and that diesel cut kind of keep that weight down. So even though some of the margins have gotten better, it's not across the barrel. So this is really going to keep refiners from really wanting to ramp up because they still have a huge glut of product to work through, and they still have a huge amount of oil sitting in floating storage, which is expensive. So you have to go through that process to really see some of this pricing get sticky over the longer term. China has aggressively come out, been bidding up, buying all of these different crudes, but it's also taking away margin. And this chart just looks at OSP, so the official selling prices. This is just a starting point. So we're actually seeing some of the new cargoes being purchased that are about $2 to $3 tighter, which just means $2 to $3 above what's printed here. So just to kind of pull one out and look at Saudi Arabia. So if we look at Saudi Arabia to Asia and we look at the light, extra light at about $5.90 to $6.50 discount, it's actually trading $2 to $3 tighter. So that is also going to weigh on margins because this is what's kind of coming away from the refiners, what goes into their pocket. And this is why, even though official selling prices have gotten tighter, the futures oil market has gotten better, we still see those overhangs that we've shown in gasoline and diesel, which just means that the refiner still isn't making that money to get them to ramp up. And this last one is just that arbitrage that we spoke about. This is what we think is going to be a hindrance in terms of getting these refiners to really ramp back up. And this is the arbitrage coming between the transatlantic. And we've seen the U.S. start to send things into Europe, and it kind of veers off and goes to another direction. Same with Europe into the U.S. So there is still not only a glut of oil in storage, but there's also a glut of product and storage. And we need to go through that in a very succinct way to really get a stickiness in this revival in oil demand. So it was a pleasure going through all this. Hopefully you're able to follow along. I know some of it gets a little complicated, so I'm always happy to take questions, go through things in a bit more depth, because refiners are really going to be a key component in understanding when they make money, then you'll start to see that resurgence. And COVID, the issues in terms of supply chains, economic overhangs we've talked about will continue to be there. So stay tuned for Friday. Friday we'll be coming to you with the primary vision frac spread count and a little bit of color around what does that mean for the U.S. supply. What does that look like in terms of some of the economic data? But otherwise, please subscribe. Let me know if you have any questions, and we'll talk to you soon. Thanks.